Every time you fill your gas tank, actually, don't kid yourself and wise up. Actually, y'all are very smart. Just take a second look at some of your habits and lifestyles, patterns, because every time you use electricity and most technology, at every turn and choice in our American lifestyle, you're funding the greatest economic warfare preparation in commodity history. Directly or indirectly, petroleum underlies so much of our lifestyle. Only the most imaginative minds find ways to distort reality enough, and only a few of us find ways to circumvent involvement, refusing quietly to participate in the circus as the larger forces at work play out on the grand scale we see today. I'm Mark Roach, and this is FutureWise Energy, an innovative voice, an upstream independent energy platform supported by just a few individuals, where I share my views across cultures, the world, technology, operating oil and gas fields, as well as executing M&A and leadership in startups in oil and gas, several $billion worth of investments. I draw from a wide range of very personal experiences from over 30 years in the industry. While market headlines obsess over Israeli-Hamas ceasefires, pushing crude below $60, the real story is still hidden, as I alluded to last week, in Chinese storage tanks. Beijing has orchestrated the most sophisticated market manipulation in oil history, absorbing 90% of global stockpiling in the past 9 months. That's over $10 billion in crude, artificially supporting prices by $5 to $10 per barrel. China isn't just buying oil. They're building the world's largest economic weapon. The large scale defies comprehension. China is adding 169 million barrels of storage capacity through 2026. That's equivalent to 2 weeks of their entire import needs. Their target, 180 days of import coverage, double the international standard. Some reports suggest they're targeting 2 billion barrels, enough for 6 months of complete supply disruption. This isn't energy security, this is preparation for economic warfare. The mechanics reveal the manipulation. China absorbs 530,000 barrels per day into storage while oil markets struggle with oversupply. They're buying during backwardation, when current prices exceed future prices. Economically irrational, unless you're preparing for conflict. And analysts estimate this stockpiling provides artificial price support that global consumers pay for. Without Chinese manipulation, oil prices would be significantly lower. The sanctions evasion network exposes the broader strategy. China imports 21% of its oil from sanctioned countries: Iran, Russia, and Venezuela. Single Chinese refineries like Shandong, Shenzhen have purchased over $1 billion in Iranian oil, wiring $800 million to Revolutionary Guard front companies. Shadow fleet tankers rebrand Iranian crude as Malaysian upon arrival. The U.S. Treasury sanctioned over 100 entities in October alone for this activity. This creates artificial demand that props up global prices while China builds strategic reserves from sanctioned suppliers at discounted rates. American consumers subsidize China's war preparation through higher gasoline prices. The manipulation is brilliant, audacious, and hidden in plain sight. Current fundamentals confirm the distortion. WTI trades at $59.54, Brent at $63, both reflecting Middle East risk premium removal. But Chinese stockpiling prevents the natural price collapse that oversupply conditions warrant. U.S. drilling activity continues declining, with 547 total rigs, down 6.5% from last year. Oil production remains near record levels at 13.63 million barrels per day. But that plateau masks the strategic vulnerability Chinese manipulation creates. Natural gas shows resilience at $3.27 per MMBTU, up 31% year over year. This strength reflects fundamental demand growth from LNG exports and data center expansion. U.S. gas production reaches 107.1 BCF per day, setting new records while export capacity expands. The divergence between oil and gas prices reflects different strategic dynamics. Gas benefits from genuine demand growth, while oil prices remain artificially supported by Chinese manipulation. The investment implications are profound. Traditional oil pricing models based on supply and demand fundamentals no longer apply when state actors manipulate markets for strategic purposes. Energy security and economic warfare have merged. Chinese storage companies represent indirect plays on this manipulation, while U.S. energy security investments become policy priorities as bipartisan legislation targets Chinese strategic petroleum reserve access. Market structure evolution accelerates as granular location-specific pricing replaces traditional benchmarks. This reflects infrastructure constraints and quality premiums that weren't significant when markets operated under genuine supply and demand dynamics. The shift toward geopolitically manipulated pricing changes everything for investors, policymakers, and consumers. The strategic calculus reveals China's true intentions. Current storage utilization remains only 55 to 65% of capacity. Massive room for expansion. The buildup coincides with Taiwan tensions and potential conflict scenarios. A coordinated release could crash oil prices by $10 to $15 per barrel, devastating competitor economics, while providing Beijing enormous leverage in any confrontation. The mathematics of energy transition haven't changed, but the context has. Renewable capacity additions continue, yet baseload demand growth from electrification requires firm power generation. Natural gas fills this gap more effectively than alternatives, creating sustained demand despite environmental policies favoring renewables. Chinese manipulation distorts oil markets, but gas markets reflect genuine fundamentals. This represents a fundamental shift from the market-based to geopolitically manipulated commodity pricing. The countries and companies that understand this transformation will capture value. Those clinging to traditional economic models will be blindsided by strategic manipulation disguised as normal market activity. The question isn't whether Chinese stockpiling will continue. The question is whether Western policymakers recognize economic warfare when they see it. Capital allocation, strategic positioning, and supply chain resilience now matter as much as resource quality and extraction economics. The old playbook is obsolete. This changes everything. Position accordingly. I'm Mark Roach, and this is FutureWise Energy. Keep your wits about you and your eyes wide open, and be ready to improvise.